Morning and good afternoon, everyone. It is September 25th, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start today, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you are a member of the press, please log off and reach out separately. Please also note that this webcast and your questions may be recorded. Today we have Jonathan Garner, Chief Asian Emerging Markets Equity Strategist, Laura Wang, Chief China Equity Strategist, Takeshi Yamaguchi, Chief Japan Economist, Sho Nakazawa, Japan Equity Strategist, Asenta Fu, Asia Sustainability Analyst. During this podcast, you can send us questions at any time from the Ask a Question text box. Our team are reiterating overview on Asia financials, and today we have Jonathan to share the key takeaways on the joint note with the Asia financials team. Over to you, Jonathan.
Yes, thanks very much, and welcome to everybody. So I'm just going to share my screen here, and hopefully you can see the note, which we published yesterday morning. So we are staying overweight Asia financials. Obviously, the largest component of that is banks, and that's what I'll speak to most, despite Fed cuts. So I think the reason for writing now is, a Fed cutting cycle. Does this affect the call that we're making? For us, as we'll show as we go through this, ultimately it does not. What's more important is the fact that these are local currency earning, high dividend yield stocks with stable ROE trends. So if we just sort of dive straight into it on the performance, I mean, this is a sector on the dark blue line here that has worked in absolute terms, but also it's worked in relative terms, the yellow line, really dating all the way back to the end of the COVID recession. So we've been in a period of sustained outperformance from Asia banks, coming off very low valuation levels. When we look at some of the key planks for further performance, one of the attractive features is sustainable ROE and earnings, and that powers dividend yield. So the dividend yield on the sector in blue here is still effectively double that of the Asia Pacific market overall, which is a very attractive characteristic. Now, when we look at the performance versus Fed funds, we've got performance relative in blue here, and then the Fed funds target rate in yellow. There is essentially a zero R squared and a tiny correlation coefficient on these two variables. However, if we are in a global recession, such as in 2008 or in COVID, clearly as a macro-sensitive sector, when you start thinking about credit losses in a recession, it would not be the case that banks perform well. So it is central to our view that domestic demand in Asia, which is the key driver of earnings for this sector and hence the earnings and dividend yield support, that domestic demand in Asia is resilient in the face of US tariff policies and the various other shocks to the US economy that are ongoing right now. And as part of that, we do not expect Asia to be slashing rates. We have a relatively modest forward adjustment on rates to the downside in Asia, as you'll see on this chart, and a much bigger fall in the US. And it's that narrowing of the rate differential, with growth being relatively resilient in Asia, that of course will keep currency strong and should help the sector sort of perform. If we're wrong about that, then the sector will perform less well. So when we do look at correlation to the dollar, and here we're using the classic DXY index, which is in yellow, and again, performance relative of banks to the benchmark in blue, further dollar weakness, which is our house base case, down to below 90 on the DXY in the course of next year, it should keep this performance relative moving higher. So the sort of correction that we're getting now, which is mainly related to a further surge in growth stocks, particularly tech growth in the region, that we think will resolve itself in favor of banks again, relatively quickly. So we do want to play the structural outperformance trend here and the heavy gearing to local currency earning streams. Now, clearly it varies by geography. So we have currency strength as most exemplified in Japan banks. And obviously in the case of Japan rates, the debate is whether the BOJ actually hikes whilst the Fed's cutting. But we also have renminbi strength, and we even have sort of moderate rupee strength, for example, in India, etc. Obviously for the Hong Kong banks, it's a little different because they obviously are pegged to the US dollar and they're going through a credit charge-off cycle. And our forecasts for the Indonesian rupiah, obviously they may be debatable given the current macro trajectory in Indonesia, and we're certainly not including Indonesia banks in our focus list. So just to wrap it up from me, these are the names that are currently in our focus list, including 2 exchanges, which are obviously more capital markets dependent, Hong Kong Exchange and Singapore Exchange. I'll just leave you to sort of dwell on those. You can review them in the note itself. But just to recap, it's the key large domestically exposed sector compared to, for example, IT and materials, as you see here, that are much more internationally exposed. Financials has very limited global exposure. It's 90% domestic revenue. And that's a very attractive feature in the current environment. Thanks very much. I'll wrap it up there and hand back to you, Crystal. Thanks.
Thank you so much, Jonathan. Now we are pivoting towards China, which has a very good run this year. And then some investors have mentioned that it has a disconnect with the major macro indicators. Today we have Laura here as well. And then can you walk us through what are the key drivers behind the rally, and then do you expect it to continue? Over to you, Laura.
Thanks very much, Crystal. Indeed, I think the market has been debating about what's actually driving the rally year to date so far. To your point, China has been doing extremely well, being the best performing market on the global basis over the last 12 months. For example, MSCI China had delivered close to 48% total return over the last 12 months and close to 40% total return year to date. So what we have done is we try to look at the major drivers and break down the year-to-date performance as well as the last 12 months performance for MSCI China to understand exactly who's driving it. So we look at 3 factors: dividend contribution, earnings growth contribution, as well as valuation re-rating contribution to the year-on-year performance for the index. It's not surprising to actually see that valuation re-rating is the largest driver for the performance for MSCI China. For example, I mentioned year to date, MSCI China delivered 38% of total return. So within that 38%, actually close to 30%, 30 percentage point is actually contributed by the valuation re-rating. And MSCI China's valuation had indeed re-rated from around 10 times forward PE to over 13 times forward PE now. That being said, we pay particularly attention to the more fundamental elements in this rally. The earnings growth in this year so far had also contributed a 3.2 percentage point of contribution to the total return. And if we look at the last 2 years, in fact, in 23 and 24, the earnings growth has been a positive driver for total return for MSCI China already. So in 23, it contributed 0.6 percentage point. And then last year, it actually had contributed by 5 percentage point. So you can see that for 3 years in a row, earnings growth has already been contributing positively for MSCI China's year-on-year performance. And if we look at the last time that we had earnings as a positive contributor for 3 years in a row, actually, that would be before 2010. So I would say this is a quite phenomenal achievement from an earnings contribution perspective. And we look at the earnings itself, especially if we zoom into each month over the last 12 to 24 months, basically since summer 2023, we actually see a quite clear inflection point of earnings contribution acceleration since summer 2024. Basically, since June 2024, over 75% of all the months, we saw earnings growth as a positive contributor to the annual performance on a monthly basis for MSCI China, compared to only 50% for the months leading up to June 2024. This is very consistent with our observation how MSCI China's ROE also bottomed out around summer 2024. And we actually have been highlighting the improvement of ROE and how the bottom-up efforts from Chinese corporates in terms of cutting costs, in terms of paying back more dividends and doing more share buybacks, etc., has been driving the ROE growth. So again, what we're trying to say here is that the fundamentals of Chinese corporates from a bottom-up perspective has indeed been improving, and that may not have been fully appreciated by the investors, given the more sort of overarching valuation re-rating phenomenon. Another point I want to highlight around the earnings delivery is that for 3 quarters in a row since fourth quarter 2024, MSCI China has been delivering in-line results versus consensus. This may not sound very significant, but we need to take into context that MSCI China's quarterly results had been disappointing for nearly 4 years up until fourth quarter of last year. So we are indeed at a stabilizing stage for MSCI China from an earnings perspective. And the earnings revision breadth, a metric we follow very closely to measure the number of upward revisions versus number of downward revisions. For MSCI China, this metric also turned positive finally after 4 years of staying in the negative territory. And this happened back in August, making China one of the 2 markets that's delivering positive earnings revision breadth at the moment, the other being the US market. So of course, we've talked about the improvement, the stabilization, and then the more encouraging sort of earnings revision breadth trend. So the sustainability, of course, would be the biggest question here. From here onward, how do we expect this very encouraging trend to carry on? So for this purpose, we want to understand which sectors, which industries are really driving the earnings recovery, and how are these sectors positioned to basically, sustain the current trend. We find that 3 sectors particularly represent the majority of MSCI China's index weight. That's financials, plus internet, plus information technology. These 3 sectors collectively represent close to 80% of MSCI China's index weight. And then when it comes to earnings absolute amount, as well as earnings growth trajectory, a few other sectors also actually are quite meaningful for MSCI China's earnings trajectory. So it's the 3 sectors we just mentioned: financial, plus internet, plus information technology, and then plus basically pharma. And the capital goods, which is the where we see all the latest, for example, automation, robotics, and high-end manufacturing, as well as materials, which had been showing a lot of upward revisions under the anti-involution initiative. So these 6 sectors, actually, for most of them, the earnings revision breadth had already turned positive and are showing a quite strong upward trend. One sector that actually has been showing a negative trend is internet, particularly the e-commerce sector. And this is because of the severe price competition that's been ongoing between the e-commerce players, namely Baba, Meituan, and JD. That had caused very severe earnings expectation reduction, as well as price targets reduction over the last couple of quarters. That being said, our sector analysts actually are expecting the price competition to peak out in the next couple of months. And then actually we are going to see a quite major inflection of earnings reacceleration for e-commerce sector. So as far as earnings deliveries are concerned, we think the sustainability is not bad. It's actually quite decent. The last comment I want to make is that, where are we with valuations? Even with very encouraging earnings delivery, has the market already fully priced in all the upsides and all the positive catalysts coming up? MSCI China now trades at above 13 times forward PE. This is above our base case valuation target at 11.5 times. China is still somewhat cheaper versus the rest of the global markets. For example, MSCI EM is traded at 14 times, and then S&P, of course, is traded at above 22 times forward PE. That being said, I think near term, this valuation for MSCI China, we consider it as being relatively full and fair. So we are not particularly expecting major upward re-rating from this level onwards. And we should particularly pay attention to a few things. Number one, the global liquidity situation as well as the risk sentiment. And this has a lot to do with the US market, frankly speaking, than to do with the China market. So number one. And number two, we need that positive earnings revision trend and stabilizing earnings delivery trend to continue. So third quarter and fourth quarter results would be extremely important to further solidify investors' confidence in China's macro going forward. And number three, I would say the fourth plenum. We don't have very high expectation in terms of detailed policy changes, given this usually is a very high level kind of a policy sort of announcement event, but without much details. But we want to make sure that the government will be talking about along the lines of, for example, social welfare reform and rebalancing the economy more towards consumption. I think those signals would actually help the market further build confidence in China's macro and in sort of expecting a wrap up at some point within the next 12 months or 18 months of the current deflationary situation. Without these reference during the fourth plenum, I think investors' confidence might be dampened a little bit. This is it from my side, and I'll hand it back to Crystal. Thank you.
Thank you, Laura. And then now we will move on to the next topic, which is the AI power demand. Today we have Isenta who will talk about what does it mean for water power generation and then the stock opportunities.
Yeah, thank you very much, Crystal. So as Crystal mentioned, Morgan Stanley Research has done a lot of work over powering AI over the last 2 years, and we wanted to raise investors' attention on AI's water consumption as well, which is another very important and critical sustainability consideration for AI development in the future. So per our estimates, we think that AI has like an expanding water consumption footprint, and we are estimating that by 2028, the annual water consumption for AI's Scope 1 and Scope 2, which is on-site cooling and then off-site electricity generation, to consume about 1 trillion liters of water annually every year. And this represents an 11 times increase from our 2024 estimates. And to compare that, the power demand estimates for our biofirm is eightfold between 2024 to 2028. So we think that it is important to recognize that there is a very rapid development in terms of water consumption growth. And then also, while the total water use on a global scale on an absolute basis might appear modest, as it is only 1 trillion liters by 2028 annually, we think that this could be a more localized risk, and we want to bring investors' attention to this because if we looked at the top 30 data center hubs on existing data center capacity, as well as like the growing pipelines and future secondary markets for AI development, we think that over half of these data center hubs are going to be facing medium basin physical risks. And a recent example of that is actually Amazon's Project Blue, which is located in Tucson, Arizona. And this shows that governments are actually rejecting, or the communities there are actually rejecting this data center development on the back of water use concerns. And so that gives us a good segue into the regulatory landscape, as we do see governments and regulators are starting to intervene and also starting to come through with regulatory developments or monitoring on AI's water use. So in the past, we've seen quite a bit of restrictive reactions to AI's water use. So in the past, we've seen Netherlands trying to put a moratorium on data center development based on more water use concerns, and also Singapore as well. So we're developing a little bit further from that. Instead of doing more restrictive actions, some jurisdictions such as California, Singapore, and the EU are going to introduce tax credits, disclosure mandates, and also performance benchmarks going forward to promote more water efficient technologies in terms of data center cooling. as well as basically more sustainable data center development in the future in general. So we think that for investors, this would mean 3 different strategic avenues to consider AI's water consumption in their investment framework. So first off, being investing in enablers. And this would include, for most Scope 1 cooling related liquid cooling solutions for AI hardware, because they're usually expected to be more efficient in terms of cooling the server racks, and also water recycling and treatment technologies, as a lot of the hyperscalers as well as semiconductor players are trying to use different solutions and technologies to reclaim wastewater or to replenish the water they've used. So among them, we identify 17 stocks from there, and some Asian names in there would include the Taiwan name AVC, as well as Toray Industries, which are liquid cooling player and a industry player that produces membrane for filtering or wastewater recycling, respectively. Another 2 strategic avenues is, first off, as we mentioned, the offsite electricity generation is also a huge source of water consumption for AI data centers. And so we also highlight that renewable energy players also offer indirect exposure to the reduction of offsite water consumption. And we screened 54 stocks with more than 50% revenue or capex exposure to renewable energy. So please do reach out if you'd like to see the list of stocks here. And then thirdly, but not least, we think that companies with better water stewardship or generally have better disclosure and are tracking their own water use. For example, for semiconductor players, it could be their water use or ultra pure water use per wafer. In terms of production, it's also a batch of companies that could be worth looking into. And so we've also in the report identified a list of key indicators by hyperscalers or semiconductor foundries so that it could assist investors in gauging companies' water stewardship. Yeah. So my presentation start here, and I'll hand the time back to Crystal.
Thank you, Isenta. And then last but not least, we will move on to the topic on BOJ. BOJ kept the risk study and also announced the sales of ETFs. Today we have Yamaguchi-san and Shou-san together for their BOJ outlook and also the views on the ETF sales.
Thank you, Crystal. Hi, this is Takeshi Yamaguchi, Chief Japan Economist. So Bank of Japan just had the September monetary policy meeting last week. And to our surprise, BOJ announced to sell ETFs and JDs. We knew that the BOJ was internally discussing how to get rid of these risk assets, but the timing was a bit, surprise. But in retrospect, I think equity prices were high. Also, I think there was a political uncertainty, and I thought that there might be a risk of BOJ's ETFs and JDs holdings becoming politicized in the diet, under the new administration. So my personal view is that this political uncertainty may have played a role behind this surprise announcement. The Nikkei newspapers reported this morning about the background story of this ETF announcement. And also that the Nikkei newspaper also pointed out that political factor may indeed play some role behind BOJ's decision. And in terms of the market implications, I will leave it to Nakazawa-san, which will explain its implications later after my presentation. In terms of the Governor Ueda's press conference, in the previous July press conference after the July monetary policy meeting, we thought that Governor Ueda's stance was extremely dovish. But in this press conference after the September monetary policy meeting, I thought that his presentation was more balanced, less dovish than the previous press conference in July. For example, as for the impact of tariffs on the Japanese economy, he said that there's no clear evidence that it has spread to the broader economy including capital investment, employment, and wage trends. That said, about the outlook, my sense was that Governor Ueda is still somewhat cautious about the U.S. tariff impact on the U.S. economy. He said that we must be mindful of downside risks to the economy, stemming from the potential for greater impact from the U.S. tariff policy. So our take is that Governor Ueda is still not in a rush to raise interest rates. But I think given the somewhat less dovish stance from Governor Ueda, and given the fact that two board members voted for a rate hike at the September meeting, I think market expectations for early rate hike seems to be gradually rising. Now the OIS market price in 50% chance of rate hike in the October meeting, and almost I think 80% chance of rate hike by December. But as I said, I think what matters, or I think now U.S. data will be more important than before, including the U.S. employment data, which has been trending down recently, and also holiday sales data, Black Friday sales data at the end of November and early December. And in terms of Japanese data, my view is that recent data also show some sluggishness, especially export data. This is the data from BOJ's real exports by region, and up to June, we had a pretty solid export numbers, which actually raised Japanese GDP. But from July, we are seeing some weakness, especially Japan's exports to the U.S. There was a big decline in U.S. bound exports in July, but in August we saw another big decline, 7.3% month-on-month decline. So I think third quarter exports seems to be pretty weak. In terms of China-bound exports, there was some rebound in August data, but on a Q3 basis, average basis, it's still down by 1.5%. So overall, now real exports are trending at minus 2% Q on Q. So I think in the third quarter GDP to be released in November, we may see a negative impact from this big slowdown in exports. And in terms of the underlying inflation trend, it's also not accelerating. We just had weighted median CPI, one of the measures of underlying inflation trend, which has been actually coming down at 1.1%, below 2%. So overall, I think we think the BOJ is not behind the curve, and there's still time to monitor more U.S. data, including at least a few months of employment reports from the U.S. and the holiday sales holiday sales data. So overall, I think chances of rate hike in the October meeting seem not that high in our view. As for December, I think it's going to be dependent on the U.S. data. If U.S. data turns out to be stronger than our house view of our U.S. team's cautious view, then we think that there's a risk of a rate hike at the December meeting as a risk scenario. So I stop here and back to you. I'm hand it over to Nakazawa-san.
Thank you, Yamaguchi-san. So regarding BOJ decision on ETF sales, looking back at last Friday's BOJ meeting, nothing came out even after 12:30 p.m. in Tokyo time. A few days earlier, on September 11, a well-known Reuters reporter who's regarded as a BOJ watcher had reported what felt like a leaked piece on the BOJ's ETFs. That made me expect some kind of announcement on ETFs. So I kept refreshing my screen with the F5 key, and sure enough, it came. And from my perspective as ex-BOJ, when there is no statement after 12:30, I can't help but feel a bit of nervous anticipation that something unusual might be happening. And during our marketing to Europe with Yamaguchi-san earlier this month, investors also asked us about the Reuters piece. Even so, I was surprised by how detailed the BOJ September meeting decision was on ETF disposals. Why surprised? Because Governor Ueda-san had consistently said it was premature to discuss specifics of asset disposal until the 2% inflation target was within the sight. He had avoided laying out any concrete exit plan either. So the fact that they've now released such a detailed roadmap should, in all fairness, be taken as a message that the 2% inflation target is coming into view from a strategy perspective. So it's natural that bank stocks and other financials outperformed after this announcement last week. And the exact timing of sales will still be up to the governor's judgment. But once a start date is set, it will almost certainly serve as even stronger signal compared with past communication that the 2% target is within sight. For now, the market is likely to lean toward hawkish expectations for the BOJ. Then the next question is that how should we interpret this ETF disposal plan? The BOJ has clearly shown its intent to prioritize market stability. That said, a disposal pace stretched over more than a century seems unrealistic. Tobic's constituents will rotate countless times over such a horizon, and J-REIT properties would long outlive their usable life. So it's fair to view the plan as overly conservative, even impractical. There's always a chance the pace will be revised. And once the BOJ really sees appropriate progress toward the 2% goal, investors will closely confirm the actual unwinding conditions. For example, will there be implicit rule on the upside, like the old informal guideline that triggered ETF purchases when topics drop 2% in a day? How will they smooth out the timing of sales? If the market falls sharply, they've said ETF sales could be paused, but what exactly counts as a sharp drop? And how long could a pause last? These are all important points still to be clarified going ahead. That said, the BOJ's plan is to limit sales to around 0.05% of total daily turnover in the market. If they really stick to that, the supply demand impact should be fairly minimal. So in short, while the ETF disposal decision itself was a surprise, the market reaction, like Nikkei underperforming topics and BOJ heavy stock selling off, was overreaction given the actual supply demand implications for now. And as expected, the NT ratio, which is Nikkei to topics, rebounded toward the close last Friday. Looking ahead, it's reasonable to assume that stocks with a high BOJ ownership ratio won't suffer any major negative impact from ETF sales from BOJ for now. Let me stop here and hand it back to Crystal. Thank you.
Thank you so much, Yamaguchi-san and Sho-san. Now we'll move on to the Q&A session. The first question is for Jonathan. Jonathan, what's the house dollar view now? And then do you still expect it to weaken? And then also what's the impact on your sector preferences from the dollar, and then especially the impact on financials?
Yeah, so I'll sort of take that back to front, as it were. So banks is a core recommendation based on our view of dollar weakness, but it's not the only sector that you can invest in. So high quality consumer e-commerce names that we have in our list in China, in Southeast Asia, for an EM investor in Latin America, they've been doing very well and they're core to our portfolio. And in addition, gold and gold mining exposure. Gold is the best performing asset in the world, major asset in the world this year, way outperforming global equities. So obviously, a lot hinges on continued dollar weakness. The dollar is coming off a 40-year high in real trade-weighted terms. It's had a very meaningful decline this year already. But so long as we're correct in what I laid out in my initial remarks, that the US growth slows more than rest of world, and that US rates come down faster than rest of world, and that is include obviously places like the Eurozone, where we think rates have largely completed their cycle. We just discussed the BOJ at some length. Then I think we're fairly well set. So going below 90 on the DXY, if we're wrong on that, if US growth spontaneously reaccelerates relative to rest of world, then I think banks will probably stop outperforming over the cycle. I doubt that they will actually sort of underperform. So hopefully that answers the question. Thank you.
Thank you, Jonathan. The next two questions are for Laura on China. Over the last 3 to 6 months, have the top 3 investors pushed back on MS more constructive view towards China change? And then if that's the case, what have been the most significant changes? And then what's your thoughts on the China recent decision to pause the real world asset business in Hong Kong?
Thank you very much, Crystal, and thanks to the investor who raised the question. I would say, the major pushbacks have shifted quite a bit over the last 3 to 6 months. I'll give you an example. I did a US marketing trip very recently in September, and previously the last time I was there was actually in early April when the reciprocal tariff was announced in the middle of my trip. The reason I mentioned this is that I think one of the major pushbacks we used to receive is basically regarding the U.S.-China relationship and the geopolitical uncertainty, particularly around the tariff front, right? And we all remember how a massive correction that had caused actually at the beginning of April to China market. I think fast forward to where we are today, investors' pushback against that is much lighter versus a few months ago. I think how China had handled the multiple rounds of trade negotiation with the U.S. has been largely highly regarded by investors in general, and particularly the rare earth card that can be played by China is generally viewed as being effective in these negotiations and are likely to at least maintain the status quo for the next couple of years, as globally the demand and for rare earths is still highly dependent on China's supply. And more recently, the TikTok deal, which seems to have been sealed, but we need to see more details on that to understand the dynamics between the two countries. I think investors at this point are feeling more comfortable investing in China with somewhat of geopolitical sort of concern backdrop in their mind. But I think the stage when and where geopolitical concerns would actually serve literally as a deal breaker, I think that period is not as there anymore versus a few months ago. And then the other, I think, concern shift is around the questions regarding the overall macro situation. Not because investors are just thinking that China is doing all great and reaccelerating, and not because that we are very bullish on China's outlook, which is not the case. We've always been saying that, even though the index level performance has been great, but this is a very alpha driven market, and you need to be in the right thematics, in the right sector, the right categories to enjoy the rally. This is not a broad-based beta rally market. And we also maintain the view that deflation in China will continue throughout this year and for the majority, if not the entirety of next year, 2026. But I think investors now are looking at specific thematics, particularly like humanoids, automation, biotechs, and also AI, and also to a certain degree, the new consumption themes as a set of opportunities where they still can see growth much higher than the general growth that they can see in China. And they feel that the number of stocks investable within this scope is actually very encouraging. It's not a small number of companies. So I think investors are feeling more confident looking at these stocks and potentially buying them and holding them on a long-term basis instead of being sort of very worried about policy directional shift and a macro condition sort of, reversing one way or another in a rather unexpected manner. So, and then your second question about RWA. We did a very big report on stablecoins and its development in Hong Kong, I think about a month and a half ago. We actually had always been holding a more cautious view on the prospect of stablecoins, particularly RMB related, RMB denominated stablecoins development in Hong Kong. Our view is that Beijing really wants to support Hong Kong to be a crucial global financial hub, and they will support Hong Kong in terms of legislation, in terms of infrastructure building, etc. But the actual sort of permission for crypto trading, for real world asset tokenization, and even for stablecoin issuance and launches, particularly related to offshore RMB, those will actually be monitored and be guided under quite strict guidance. And in the meanwhile, during the meanwhile, we feel that Beijing would still be prioritizing the expansion of usage and sort of implementation of digital RMB, which is more a official kind of way to expand and improve RMB's global kind of influence and RMB's internationalization. So the recent headline news about Beijing informally advising certain financial institutions to sort of kind of a pause or slow down their moves in the related areas, that's not surprising to us, and we think that's likely to stay the case in the near to medium term at least. Thank you.
Thanks, Laura. Just very quickly a follow-up. So just now you mentioned you don't expect the market performance to be broad-based. So currently, what's your sector preferences? Also, what's your thematic preferences in China?
Yeah, so we do prefer internet because we feel internet it's a number one. I think in my earlier comments we talked about the bottom-up sort of self-help efforts, and a lot of those were done by internet companies in terms of cost cutting, paying more dividends, and doing share buybacks, and those are still very much ongoing, right? And also, some of these large cap internet companies are also transforming themselves into AI leaders. And for example, we have both Tencent and Alibaba in our focus list. And those are two names we feel that are combining the advantages of large sort of internet players with very well established ecosystem and with a real commitment and innovation and R&D capability in AI. So we obviously prefer that. And we also continue to advise investors to also maintain certain exposure to dividend play names, because we do expect in the second half or coming into towards the later part of this year, volatility could be higher versus the first part of this year, given how much the market has already rallied. So I think certain dividend exposure would help you basically smooth out a lot of the volatilities and can give you stable cash returns. We still don't like sectors like properties or consumer staples. To my earlier point, we don't think the deflationary environment would go away anytime soon, and those two categories are heavily correlated with the sort of lackluster spending power and reluctance to sort of take leverage and buy housing, etc. So we are not particularly positive on those. Thank you.
Great, that's super clear. Thank you, Laura. The next set of questions are on Japan. This is for Yamaguchi-san. Does underlying inflation refer to services inflation or some other measures? And then secondly is on the prime minister candidates. What's the likely fiscal and regulatory policy reaction functions of the two candidates, Koizumi-san and Takaichi-san? And then what's your view on fiscal impulse coming through in the supplementary budget in December?
Okay, thank you. So as for the first question, as for the underlying inflation, there's no one measure. And in speech in June, Governor Ueda showed these four charts as indicators related to underlying inflation. And in July press conference, he mentioned weighted median CPI, services, and inflation expectations. But he didn't refer to BOJ's own macro-based model. Which seems to be already, approaching 2%. So I think Governor Ueda seems to be more cautious. But I think, some, recent, hawkish, board members may be affected by BOJ's own estimate, model-based estimate of, underlying inflation trend. So to your question, yes, service is one of them. But that's, I think they look at various indicators. And as for the, second question, I think in general, yes, Takaichi-san has a more, I think, expansionary in terms of the fiscal policy and maybe supporting easy monetary policy. But she, I think, refrained from like a consumption tax cut or more other extreme comments on diplomatic policy or on the BOJ. So my sense is Takaichi-san is becoming more moderate. So I think so the difference between these candidates may not be that significant. Although Takaichi-san is slightly more expansionary in terms of the macro policy. And as for the supplementary budgets, I think regardless of who becomes the next prime minister, I think one of the important factors would be the third quarter GDP to be released in November. If the third quarter GDP turns out to be negative Q on Q, mainly due to weak exports, then I think the size of the economic package and supplementary budget will be larger. That will be formulated in December. So I think that will be one important data point to monitor going ahead. So I stop here and back to you, Crystal.
Thank you, Yamaguchi-san. And then the next one is on the market reaction post the LDP leadership race. This is for Shou.
Sure. Thank you, Crystal. So from a market perspective, Takaichi-san is seen as a most bullish candidate for equities, as Yamaguchi-san pointed out, given her stance on expansionary fiscal policy comparing with Koizumi-san, increased defense spending and nuclear energy listers as well. So if Takaichi-san wins, the initial market reaction is expected to be weaker yen, higher equities, and lower bond prices. This combination is likely to include high beta stocks, defense, and nuclear-related industries as well. As for Koizumi-san, while he's known for reform-oriented, like his father, is more fiscally conservative and less inclined toward consumption tax cuts. So his victory could lead to rising short-term interest rates, declining long end. So JGB yield curve might be twist flattening going forward. So foreign investors may appreciate his moderate stance on labor deregulation and pragmatic security and energy policies as well. But due to his cautious fiscal approach, comparing with Takaichi-san, sharp equity rally like under Takaichi-san is less likely. And some macro hedge funds and global long-only investors suggest that if Koizumi-san wins, equities might peak in short-term basis. Let me stop here and pass it back to Crystal.
Great. Thank you so much, Shou-san. So in the interest of time, we'll conclude today's webcast here and answer the remaining questions offline. Thank you so much for joining us, and then do reach out to me and the team if you have any other questions. Have a nice day and see you next week.